Hey everyone, welcome back to the channel. If you're new here, I'm Govi, and today we're diving into a topic that sits at the heart of corporate finance capital structure decisions. Now, before you click away thinking this is going to be a math-heavy nightmare, don't worry. I've cut out the messy formulas. Instead, we're going to understand the logic behind how companies decide how much debt and how much equity they should use to fund their business. This is part 1, so let's get started. Section 1. What is capital structure? So, first things first, what does capital structure even mean? It's basically the way a company finances its operations and growth using two main sources. 1. Debt, money borrowed from banks or investors. 2. Equity, money raised from shareholders. Think of a company like a car. Debt is like fuel you borrow. You get where you want faster, but if you spill it, the car might blow up. Equity is like solar power. It's safer, but slower, and you need more panels to get the same power. Companies constantly balance these two sources to reduce cost, improve returns, and avoid financial trouble. Section 2. Why capital structure decisions matter. So, why does capital structure matter so much? Because it influences three major things. 1. Cost of capital. Debt is usually cheaper than equity because lenders take less risk than shareholders. But too much debt increases risk and eventually becomes expensive. 2. Financial risk. Borrowed money needs to be repaid with interest. If the business slows down, high debt can push a company toward bankruptcy. 3. Shareholder returns. The right mix can boost earnings per share, but the wrong mix can destroy the company. This makes capital structure decisions one of the most strategic choices managers make. Section 3. The debt-equity trade-off. Here's where things get interesting. Capital structure is basically a balancing act between the benefits of debt and the risks of debt. Let's break it down. Advantages of using debt. 1. Cheaper financing. Companies don't give up ownership. Debt holders get fixed interest, not profits. 2. Tax benefit. Interest is tax-deductible, so companies save money. 3. Leverage effect. If the company earns more than the interest it pays, shareholders gain even bigger returns. Disadvantages of using debt. 1. Fixed obligation. Interest must be paid even when profits drop. 2. Increased default risk. Too much debt scares investors and lenders. 3. Lower flexibility. High debt restricts future borrowing and investment. So the decision isn't simply debt is good or debt is bad. It's about finding the optimal mix, the point where the benefits of debt are still greater than the risks. Section 4. Factors affecting capital structure. Now let's talk about what influences these decisions. Because not all companies follow the same strategy. 1. Nature of business. Stable cash flow industries like utilities use more debt. Tech startups. Usually low debt there too unpredictable. 2. Business risk. If the company's earnings jump around a lot, it should use less debt. More risk outside gives less risk inside. 3. Company size. Large companies get better access to loans, lower interest rates, and usually have diversified earnings, so they can afford slightly higher debt. 4. Flexibility needs. Some companies prefer staying flexible and keeping borrowing capacity available for future expansion. 5. Control considerations. Issuing equity dilutes ownership. Founders who want control often prefer debt over selling shares. 6. Market conditions. When interest rates are low, debt becomes attractive. When stock markets are booming, companies may issue equity at high valuations. These factors interact in complex ways, but understanding them helps managers avoid dangerous financial decisions. Section 5. Capital structure theories. Now let's quickly touch on some well-known theories, but don't worry, I'll keep this simple. 1. Modigliani-Miller theory. In a perfect world, capital structure doesn't matter. Debt or equity, same effect. But we don't live in a perfect world. 2. Trade-off theory. Companies balance the tax benefits of debt against the risk of financial distress. Use debt until the cost of extra risk outweighs the tax savings. 3. Pecking order theory. Companies prefer 1. Internal funds. 2. Debt. 3. Equity. Why? Because equity sends signals to the market, often negative. Managers avoid issuing equity unless absolutely necessary. These theories don't always predict real-world behavior perfectly, but they give us frameworks to think about capital structure decisions. This is part 2 of our series on capital structure decisions. In this part, we're going deeper into how companies determine the optimal capital structure, real-world examples, warning signs of a bad capital structure, and the strategic approaches companies actually use. Let's jump right in. Section 1. What is optimal capital structure? Okay, let's start with the star of today's episode, the optimal capital structure. This is the mix of debt and equity that minimizes the company's overall cost of capital, maximizes firm value, keeps financial risk at a manageable level. Remember from part 1, too little debt means you may be missing out on the benefits. Too much debt means you're inviting financial distress. But here's the catch, there's no universal formula. Each company's optimal level is unique. How companies think about optimal capital structure. 1. How stable are our profits? Stable gives more debt possible. Unstable gives go easy on debt. 2. What stage is our business in? New to growing gives lower debt. Mature cash cows gives higher debt. 3. What's happening in financial markets? Low interest rates gives debt becomes attractive. High stock valuations gives issuing equity becomes cheaper. 4. What's our long-term strategy in expansion? Acquisitions. Sometimes companies reserve debt capacity for future moves. So optimal capital structure is not a fixed number, it's a moving target that changes as the company and the environment change. Section 2. Real-world examples. Now let's look at how real companies handle their capital structures. These examples aren't about numbers, they're about strategy. 1. Apple low debt for years, then strategic borrowing. Apple used to avoid debt almost completely. Then it realized something clever. It could borrow cash at extremely low interest rates instead of taxing its overseas earnings. So, even though Apple had billions in cash, it borrowed billions more. Why? Because the cost of borrowing was lower than the tax they would pay to bring overseas money home. Lesson: even cash-rich companies use debt when it's strategically smart. 2. Tesla, high equity, low debt in early years. In its early stages, Tesla relied heavily on equity financing because cash flows were unpredictable, debt would have been too risky. Investors believed in its long-term story. Once Tesla stabilized, its ability to borrow improved. Lesson: high growth, high-risk companies use more equity early on. 3. Airlines, a heavy debt industry. Airlines often use large amounts of debt because aircraft purchases are extremely expensive. Revenue is relatively stable over long periods. They can use planes as collateral. But during crises like the pandemic, this high debt becomes a huge vulnerability. Lesson: high debt industries suffer most during downturns. Section 3. Signs of an unhealthy capital structure. Now let's talk about warning signs, the red flags that tell us a company's capital structure is becoming dangerous. 1. Interest coverage falling. If a company struggles to pay interest from its operating income, that's a problem. This doesn't need calculation, just look for phrases like declining earnings, high interest burden, debt restructuring needed. 2. Constant refinancing. If the company keeps rolling old debt into new debt, it's a sign cash flow isn't strong enough. 3. Credit rating downgrades. Lower ratings mean higher borrowing costs and increased risk. 4. Negative market sentiment. If investors feel the firm is over-leveraged, its stock may suffer. 5. Reduced flexibility. When debt becomes too high, the company can't invest in new opportunities, can't respond to emergencies, may lose strategic freedom. These signals don't always mean bankruptcy is coming, but they point toward a capital structure that needs adjustment. Section 4. How companies adjust capital structure. Now let's look at strategies companies use to fix or optimize their capital structure. 1. Issuing new equity. If debt is too high, companies may issue shares to raise cash and pay down loans. 2. Paying down debt gradually. Companies with improving cash flows reduce debt over time. 3. Refinancing. Replacing high-interest loans with lower-interest loans can reduce financial pressure. 4. Retaining earnings. Instead of paying dividends, firms keep profits inside to strengthen equity. 5. Selling non-core assets. A quick way to eliminate debt and focus on core operations. The right strategy depends on the company's health, market conditions, and long-term plan. And that wraps up part 2 of our series on capital structure decisions. We explored optimal capital structures, real examples, warning signs, and the strategies companies use to manage their financing mix. If you enjoyed this both part, don't forget to like the video, subscribe, and share it with anyone studying finance or running a business. Thanks for watching, and I'll see you in the next one.